KBC Groep NV, KBC, is a highly integrated Belgian bank insurance group that maintains a strategic focus on retail, private banking, and small to medium-sized enterprises, SMEs, across its core markets in Belgium and Central and Eastern Europe, CEE. The institutional analysis confirms KBC's position as one of Europe's most profitable financial institutions, demonstrating superior operational efficiency and robust capital management despite operating in a challenging macroeconomic and geopolitical environment. 1.1 Strategic Positioning: The Resilient Bancassurer Model. KBC's core structural strength derives from its integrated bancassurance model, which provides exceptional revenue diversification and inherent resilience against cyclical economic downturns. Non-interest income streams, encompassing fees, commissions, and insurance premiums, contribute approximately 50% of the group's total revenues. This balanced income mix underpins customer loyalty and results in lower overall earnings volatility compared to pure-play banks heavily reliant on net interest income, NII. The group operates on a dual core market foundation. The highly stable, developed, and dominant Belgian franchise acts as a low-risk anchor, complemented by strategic, high-growth, higher-margin operations in the dynamic CEE cluster, including the Czech Republic, Slovakia, Hungary, and Bulgaria. This geographic diversification, coupled with a generally conservative risk appetite and integrated risk controls, allows the group to exploit growth opportunities while containing volatility associated with less developed operating environments. 1.2 Key Financial Performance Indicators, Q3 2025. KBC delivered strong financial performance throughout 2025, culminating in an excellent net profit of €1.002 billion for the third quarter. This performance was driven by the core bank insurance franchises and effective digital execution, resulting in a year-to-date YTD return on equity (ROE) of 15%, positioning KBC among the most profitable financial institutions in Europe. Operational efficiency has improved significantly, with the cost-to-income ratio, excluding bank and insurance taxes, improving to 41%. Furthermore, the group's capital base remains exceptionally strong, reporting an unfloored fully loaded Common Equity Tier 1 (CET1) under Basel IV of 14.9% at the end of September 2025. Management confidence in sustained profitability led to an increase in full-year 2025 guidance for net interest income (NII) to at least €5.95 billion, up from €5.85 billion previously, and total income growth to at least 7.5%, up from 7.0%. 1.3 Investment Thesis and Key Risks. The investment thesis for KBC is grounded in superior execution, high profitability, and a stable capital return policy. KBC's premium valuation, evidenced by a price-to-book ratio, P/B, ranging from 1.76 to 1.85, and a price-to-earnings ratio, PE, between 11.84 and 12.5, is justified by its consistently high ROE, 15, and the demonstrated efficiency gains derived from its digital transformation efforts. The integrated model provides a structural hedge against traditional banking volatility, confirmed by the low beta rating of 0.97. The primary financial risk stems from the potential mean reversion of credit costs. The year-to-date credit cost ratio of 12 basis points, BPS, is exceptionally low and well below the through-the-cycle target of 25 to 30 BPS. Normalization of this ratio, particularly as economic conditions in CEE evolve, could act as a headwind to future earnings. The main structural risks are unquantifiable geopolitical instability, which continues to limit the ability of credit models to adequately reflect all resulting economic consequences, and associated increased cyber attack risks, particularly from state-sponsored actors targeting financial markets infrastructure. Group Strategy and Business Model Analysis. 2.1 The Strategic Advantage of Integrated Bancassurance. KBC's integrated bank insurance strategy is designed to maximize client interaction value and cross-selling opportunities, a critical factor underpinning its earnings stability. The model allows KBC to offer comprehensive solutions, leading to higher client retention and better insights into client needs, thereby enhancing revenue per client. The group's insurance operations contribute robustly to overall performance, highlighted by the superior underwriting discipline in the non-life segment. For the third quarter of 2025, KBC reported a combined ratio of 87%. This figure significantly outperforms the internal strategic target of less than 92%, indicating excellent claims management and pricing sophistication. In life insurance, KBC manages low interest rate risk by applying a cash flow matching policy to portfolios covered by fixed income securities. Furthermore, the asset management business is showing strong momentum. Total assets under management, AUM, grew by 8% year-on-year to €292 billion by the end of September 2025. This growth was evenly split, with half attributed to positive market performance and the other half resulting from net inflows. The ability to attract substantial net inflows underscores the success of the multi-channel approach and the trust clients place in KBC's investment management capabilities. The high proportion of non-interest income, approximately 50% of total revenue, resulting from this integrated approach provides a fundamental cushion against compression in net interest margins, NIMs, during shifting interest rate cycles. While elevated interest rates boost NII, the diversification ensures that core earnings remain robust even if rates 2.1. The strategic advantage of integrated bancassurance. KBC's integrated bank insurance strategy is designed to maximize client interaction value and cross-selling opportunities, a critical factor underpinning its earning stability. The model allows KBC to offer comprehensive solutions, leading to higher client retention and better insights into client needs, thereby enhancing revenue per client. The group's insurance operations contribute robustly to overall performance, highlighted by the superior underwriting discipline in the non-life segment. For the third quarter of 2025, KBC reported a combined ratio of 87%. This figure significantly outperforms the internal strategic target of less than 92%, indicating excellent claims management and pricing sophistication. In life insurance, KBC manages low interest rate risk by applying a cash flow matching policy to portfolios covered by fixed income securities. Furthermore, the asset management business is showing strong momentum. Total assets under management, AUM, grew by 8% year-on-year to €292 billion by the end of September 2025. This growth was evenly split, with half attributed to positive market performance and the other half resulting from net inflows. The ability to attract substantial net inflows underscores the success of the multi-channel approach and the trust clients place in KBC's investment management capabilities. The high proportion of non-interest income, approximately 50% of total revenue, resulting from this integrated approach, provides a fundamental cushion against compression in net interest margins, NIMs, during shifting interest rate cycles. While elevated interest rates boost NII, the diversification ensures that core earnings remain robust, even if rates decline, mitigating the inherent cyclicality of pure banking revenues. 2.2. Geographic strategy, the CEE growth multiplier. KBC's geographic footprint is deliberately concentrated in two distinct areas: the mature, highly developed market of Belgium and the higher growth but more volatile markets of Central and Eastern Europe. KBC is one of the largest banking groups in Belgium and holds a leading market position in the Czech Republic. Its well-established market footprint also extends to Slovakia, Bulgaria, and Hungary. The CEE exposure acts as a growth multiplier for the group. While these markets inherently present more volatile operating environments, KBC's conservative risk appetite and strong integration of risk controls help contain potential earnings and asset quality volatility. The loan portfolio experienced an 8% increase year-on-year, demonstrating effective capture of regional demand. KBC primarily pursues organic growth, but the strategy is flexible, allowing for small-scale bolt acquisitions in both Belgium and CEE countries to achieve increased scale and market depth. In the competitive landscape of CEE, KBC is benchmarked against major regional players such as Erste Group, OTP, UniCredit, and Raiffeisenbank International. KBC's structural advantage over some CEE-focused peers is the stability provided by the Belgian core, allowing it to navigate CEE's inherent macroeconomic and geopolitical challenges with greater financial backing. 2.3. Digital transformation and operational excellence. Central to KBC's strategy is its data-driven digital transformation, culminating in the development and deployment of the Kate AI platform. Kate is positioned as the AI-enhanced infrastructure core to the organization, designed to deliver instantaneous, frictionless interactions with clients by combining financial and non-financial services. The effectiveness of this digital strategy is quantifiably demonstrated through efficiency gains and sales growth. The cost-to-income ratio has notably improved to 41%, a significant step towards achieving strong, positive operating jaws. This efficiency gain is directly correlated with Kate's high adoption and functionality, achieving autonomy rates of 70% in Belgium and 71% in the Czech Republic. Furthermore, Kate has proven its revenue generation capability by directly facilitating 400,000 sales transactions over a 12-month period. This operational excellence underpins the strategic target of achieving strong positive jaws, requiring total income to grow faster than operating expenses. The stated long-term targets call for a total income CAGR of plus or minus 4.5% versus an operating expenses CAGR excluding bank taxes of plus or minus 1% over the 2021-2024 period. The Q3 2025 performance, with total income guidance raised to greater than or equal to 7.5% growth, suggests that the digital strategy is over-delivering on these efficiency and revenue targets. 3. Financial Performance Review, Q3 2025 and Outlook. 3.1. Income Statement Dynamics. KBC's strong financial trajectory throughout 2025 was sustained into the third quarter, reporting a net result of €1.002 billion. Total income benefited from increases in net interest income, insurance revenues, and net fee and commission income. The most significant operational indicator for future earnings confidence is the raised guidance for net interest income, NII, now projected at a minimum of €5.95 billion for the full year 2025. This increase, reflecting favorable balance sheet management and optimized rate sensitivity, drove the upward revision of the overall total income growth guidance to at least 7.5%. Loan growth remains robust, expanding by 8% year-on-year, while customer deposits remain stable, supporting the group's strong liquidity position and facilitating funding for the high-growth CEE segment. Minor fluctuations in Q3, such as the decrease in trading and fair value income and dividend income, are noted, but these reductions occurred relative to a seasonal peak in the second quarter, confirming that core operating income streams are the sustained drivers of growth. 3.2. Profitability and Return Analysis. KBC's profitability metrics are robust and indicative of a financially disciplined institution. The year-to-date return on equity, ROE, reached 15% for the first 9 months of 2025, confirming the group's elite status among European financial institutions. The improved operational efficiency, reflected in the cost-to-income ratio of 41%, is paramount to sustaining this high ROE. This improvement is not merely a cyclical artifact, but a structural gain, directly attributable to the investment in technology, automation, and the Kate AI platform. By maintaining strict control over operational costs, KBC successfully achieves superior profit conversion from its robust revenue streams. 3.3. Asset quality and credit cycle positioning. Asset quality remains stable, reflecting benign cyclical conditions and KBC's prudent risk appetite. The credit cost ratio for the first 9 months of 2025 was exceptionally favorable at just 12 basis points, BPS, well below the targeted through-the-cycle credit cost ratio of 25 to 30 BPS. However, this exceptionally low credit cost ratio necessitates careful interpretation. The current performance provides an artificial boost to net income and is not representative of long-term sustainable earnings. Given KBC's significant exposure to the CEE markets, which are inherently subject to greater volatility, a reversion to the management's through-the-cycle target of 25 to 30 BPS is expected as economic conditions inevitably normalize or tighten. Investors modeling long-term sustainable ROE should account for this normalization risk, discounting the current 15% ROE by the potential increase in provisioning expenses. Furthermore, geopolitical uncertainty poses a measurable challenge to risk management. The group's credit models face inherent difficulties in adequately reflecting all the consequences of geopolitical conditions, requiring management to recognize post-model adjustments in addition to the expected credit loss provisions produced by standard models. This acknowledges the limits of quantitative modeling in high-risk environments and demonstrates a conservative provisioning philosophy. IV. Capital, liquidity, and risk management. KBC is defined by its robust financial safeguards, consistently maintaining capital and liquidity metrics significantly above regulatory minimums. 4.1. Capital adequacy and distribution capacity. The group's solvency position is formidable, with an unfloored fully loaded CET1 ratio under Basel IV of 14.9% at the end of September 2025. This ratio is highly significant as it approaches the internal trigger point for surplus capital distributions. KBC's dividend policy targets a payout ratio of greater than or equal to 50% of profit, with the board of directors having the discretion to pay out any portion of capital exceeding the 15% CET1 ratio threshold. Reaching this 15% threshold suggests a high probability of continued discretionary distributions, such as the recent updates regarding the group's share buyback program. Capital efficiency is actively managed through strategic transactions. Notably, KBC successfully completed its inaugural significant risk transfer transaction on a €4.2 billion corporate loan portfolio. Such transactions optimize risk-weighted assets (RWA) usage, freeing up capital to support continued organic growth and maintain the high CET1 ratio necessary for shareholder distributions. 4.2. Funding and liquidity profile. KBC maintains a very solid liquidity profile, as demonstrated by its core regulatory ratios. The liquidity coverage ratio, LCR, stands at 158%, and the net stable funding ratio is 134%. These ratios significantly exceed regulatory requirements, confirming strong short-term resilience and long-term stable funding capabilities. The group's high-quality liquid assets, HQLA, pooled approximately €100 billion in September 2024, representing about 29% of total assets. This pool is conservative in composition, with 43% held in cash and 57% in high-quality European Central Bank eligible bonds. This robust liquidity profile assures both the market and regulators of KBC's ability to withstand systemic stress. 4.3. Market and structural risk analysis. Interest rate risk. KBC has demonstrated limited interest rate sensitivity in its banking book. The Scenario Outlier Test, SOT, Economic Value of Equity, EVE, for the banking book stood at minus 5.20% of Tier 1 capital at year-end 2024. This is notably well below the European Central Bank's monitored minus 15% threshold, indicating that the overall interest rate risk of the balance sheet is tightly managed and hedged. The SOT net interest income sensitivity was also limited, reporting minus 1.55%. This quantitative management confirms that KBC is structurally protected against extreme rate cycle volatility, partly due to disciplined balance sheet management and partly due to its reliance on stable non-interest income. Geopolitical and cyber risk. While KBC exhibits exceptional control over traditional quantifiable financial risks, the operations in CEE introduce systemic, unquantified risks, primarily geopolitical instability. The risk report confirms that a specific, quantifiable figure for geopolitical exposure in CEE is unavailable in detailed reports. This inherent uncertainty is the primary non-financial constraint on the group's valuation, reaching that of purely Western European peers. This geopolitical exposure directly translates into heightened operational risk, specifically in the realm of cybersecurity. Following the Russian invasion of Ukraine, the European Union has faced an increased risk of disruptive, state-sponsored cyber attacks targeting critical institutions such as financial markets infrastructure. KBC has reported that some attacks, e.g. DDoS and password spraying, targeting group entities can be attributed to pro-Russian hacker groups. The sophisticated digital strategy, while driving efficiency, also increases the attack surface, making information security risk, third-party and outsourcing risk, and business continuity risk paramount concerns for management. The high CET1 ratio of 14.9% effectively serves as a substantial self-imposed buffer, compensating for these unpredictable and systemic external risks that cannot be eliminated by internal risk controls alone. V. Valuation and shareholder returns. 5.1. Valuation metric deep dive. KBC trades at a significant premium relative to many European and CEE banking peers, reflecting the market's recognition of its operational superiority, structural stability, and high ROE. The latest price-to-earnings ratio, PE/TTM, is between 11.84 and 12.5. The price-to-book ratio, PB, is high, ranging from 1.76 to 1.85. This PB multiple is high for the European banking sector and indicates strong investor confidence in the group's ability to consistently generate returns significantly above its cost of equity. The tangible book value per share is approximately €67.98. Furthermore, KBC's beta is rated at 0.97. This value confirms that the stock exhibits slightly less volatility than the overall market, positioning KBC as a defensive, stable selection suitable for balanced portfolio mandates seeking high-quality financial exposure. 5.2. Peer Group Comparative Analysis. A comparative valuation against CEE-focused competitors underscores the market's differentiation based on business model and geopolitical risk profile. KBC's 15% ROE is structurally strong, though slightly lower than Erste Group Bank's 18% return on tangible equity, ROTE. However, the key differentiation lies in the valuation multiple disparity. Raiffeisen Bank International, RBI, which has a high exposure to Eastern Europe, trades at a substantial discount with a PE of 3.90 and PB of 0.34. This gap confirms that the market applies a significant geopolitical risk discount to RBI, while PBC benefits substantially from the perceived safety and stability provided by its dominant Belgian anchor. The high PB multiple assigned to KBC reflects the perceived security of its capital base and the reliability of its diversified earnings. 5.3. Capital Return Strategy. KBC maintains a high commitment to shareholder returns, explicitly targeting a dividend payout ratio of greater than 50%. The group paid an interim dividend of €1 per share on November 7, 2025, as an advance on the total dividend for the year. The trailing 12-month dividend yield is approximately 3.31%. Crucially, KBC's policy regarding capital above the 15% CET1 threshold dictates that any surplus may be returned to shareholders. Given the current CET1 ratio of 14.9%, the group is poised to initiate or significantly increase discretionary capital distributions, such as share buyback programs, provided the robust profitability is maintained. The investment case therefore leans heavily on total shareholder return, combining consistent dividends with the potential for substantial buybacks. V. Analyst Consensus. 6.1. Review of Sell-Side Sentiment. The institutional view on KBC Group is overwhelmingly positive. The stock holds a consensus rating of buy based on the insights provided by 16 independent analysts. However, the consensus price targets suggest the current market price is largely reflective of the group's strong fundamentals and raised guidance. The average 12-month price target is €109.11, with a high estimate of €128 and a low estimate of €87. Based on the current trading price, the implied upside potential is marginal, at only plus 2.21%. This limited upside suggests that analysts have largely incorporated the superior 15% ROE and the raised NII guidance into their valuation models. For KBC to generate significant alpha, it would require a structural, unanticipated increase in profitability or a material, accretive acquisition. The fair value assessment, discounted back to 2025 at a 7.08% rate, yielded €106.66, reinforcing the view that the stock is currently trading near its intrinsic value based on forward earnings expectations. 6.3. Conclusion. KBC Groep NV is a financially disciplined, technologically advanced, and structurally resilient financial institution. Its integrated bank insurance model and leading market positions in Belgium and the Czech Republic provide stable, high-quality earnings. The group's Q3 2025 results confirm superior operational leverage, 41% CI ratio, and profitability, 15% ROE, backed by an exceptionally strong capital buffer, 14.9% CET1. However, the high PB multiple, 1.76 to 1.85, and the marginal implied upside, 2.21%, suggest that the stock is currently fully priced for its operational perfection and raised guidance. While the company is actively managing its credit risk and has successfully minimized interest rate exposure, the exposure to unpredictable geopolitical risks and associated cyber threats remains the chief unquantified uncertainty. The exceptionally low credit cost ratio is expected to normalize, which will exert pressure on future net income. Recommendation: KBC warrants a neutral rating based on capital appreciation potential, but remains highly attractive for income-focused portfolios. The company is fundamentally a high-quality financial asset that has executed flawlessly on its strategic goals. Given the limited price upside, KBC is best suited for investors seeking stability, reliable high capital returns, dividends greater than 50% payout, plus buybacks upon reaching 15% CET1, and low market volatility, beta 0.97. New investors should await a more favorable entry point or deploy capital only if prioritizing total shareholder return over immediate capital gains.